Okay, I am recording and we're started. Here we go. So my name is Jason Parker. Some of you are brand new here. You're just here because maybe you signed up for the retirement budget calculator. And today that's what this is all about. And I have to tell you, we have been working now for years on the retirement budget calculator. And I have a dream that we are going to be able to help every American achieve clarity, confidence, and freedom as they prepare for and transition through retirement. And that dream is getting closer and closer all the time to what I originally envisioned. So I'm really excited. This is the first webinar that we've done since we launched the newest retirement budget calculator 4.0. And today what I really want to do is I want to answer your questions to make sure that you know how to use the calculator. I've prepared just a demo account to show you how you get in there and how you enter information and how you can evaluate the information. And yeah, so we'll just dive into it. For those of you that are just joining, there is an opportunity to ask questions as we go, and I want to answer your questions. I'll answer as many of them as I can. I may not be able to get to all of them, but I will do my best. And as questions come up, just go ahead and type them as you have questions. And I promise that at the end of the webinar today, I'll go back through and I'll make sure that I've addressed all the questions that are being asked. Now, can everybody see me and see my screen okay? So let's jump into the retirement budget calculator. And one of the things that I have been talking about, if you listen to the podcast, Sound Retirement Radio, I've been talking about this idea of being able to incorporate artificial intelligence into your financial life. And I notice that many of you have been talking with you and asking Finn questions. Finn, of course, is our AI assistant. And many of those questions have been related to how to use the calculator. But I want to expand your mind a little bit. I want you to think more fully about the power of what we've provided to you here. Let me pull up Finn. If you don't know how, you just click on his face. This is Finn. He says, "Hi, my name is Finn, your AI financial assistant. How can I assist you with your retirement planning today?" And down below, we're going to give him a quick question that says, "Hi, Finn, I'm holding a webinar to introduce you to the world. Would you like to say hi?" Finn says, "Hello, everyone. I'm Finn, your retirement assistant. I'm here to help you navigate the complexities of retirement planning, budgeting, and investing. If you have any questions about using the retirement budget calculator or need guidance on retirement-related topics, feel free to ask." And I've got another question. I just want to show you the power of Finn here. I know how much you guys enjoy my jokes on the podcast, but Finn, do you have a good joke for us? Absolutely. I'd love to share a joke. Here it goes. Why don't retirees mind being called seniors? Because the term comes with a 10% discount. Okay, Finn. Let's ask him, why is having a AI financial assistant important? 24/7 availability, efficiency, consistency, cost-effective, personalization, educational. So let's dive a little bit deeper with Finn. And instead of just thinking about asking him questions about how to use the calculator, let's ask him questions, the type of questions that people ask me every day. Here's one. Which states have an inheritance tax? And of course, Finn will tell you, as of the most recent information, Iowa, Kentucky, Maryland, Nebraska, New Jersey, Pennsylvania. Let's ask him this question as we dive a little bit deeper into it. Which state is the best to die in for estate tax planning purposes? Alaska, Florida, Nevada, South Dakota, Texas, and Wyoming. Here's another question that we hear frequently from people. How can I pay less money in taxes? And he says, maximize retirement contributions, utilize tax credits, itemize deductions, consider health savings accounts, tax-efficient investments, tax loss harvesting, charitable donations, educational savings plans, business deductions, estate planning. And so then what I want you to think about is after you ask a question, I want you to go a little bit deeper. So up here, you notice he talked about utilize tax credits. So then we'll follow up with that question with another one and say, what tax credits are available in 2024? And he says the child tax credit, earned income tax credit, child and dependent care credit, education credits, American Opportunity Credit, lifetime learning credit, premium tax credit, savers credit, residential energy credit, clean vehicle credit, adoption credit, foreign tax credit. And so we want to go a little bit deeper with them and say, tell me more about the residential clean energy credit. what does it take to qualify? And so he goes on to say, this is a tax credit, so you can use solar panels, solar water heaters, wind turbines, geothermal heat pumps. From 2022 to 2032, it's 30% of the cost of the qualifying system, with no annual maximum or lifetime limit. Eligibility requirements has to be primary residence, new installations, ownership, installation date, how to file, how to claim the tax credit. And then we're going to go a little bit deeper with them. So we're going to ask them this question here. We're going to say, regarding this tax credit, if my taxable income is $100,000 and the cost to put solar panels on my house is $50,000, how would the clean energy credit impact my situation? And Finn's going to give us some advice, or not advice, but some guidance. Let's break it down. And he says, calculation of the credit. For the tax year 2023, the residential clean energy credit is 30% of the cost of qualifying system. Cost of solar panels, $50,000. The credit percentage would be 30%. The credit amount would be $15,000. Impact on your tax situation. The $15,000 credit will directly reduce your tax liability. Here's how it works. Taxable income is $100,000. Assume that the tax liability is $20,000. And he says, so if you had a tax liability of $20,000 and you use the residential clean energy credit for $15,000, your remaining tax liability would be $5,000. And then, of course, there's important considerations that he shares you with. And one of the things you'll notice about Finn, your AI assistant, is he's always going to recommend that you get professional advice, whether that's from a CPA, a financial advisor, an attorney. You don't want to rely solely on Finn because he can make mistakes. But I will tell you, the information that he provides is really pretty incredible. And you can spend a lot of time just digging into finance. And you guys really, truly are the RBC nerds. I mean, for you to be here on a Friday afternoon in the middle of summer, it really says something about our audience, which is pretty stellar. So I just wanted to make sure you understood the power of what we've brought to you. We've done something in this space of retirement planning that is completely transforming the way that people are the type of advice people get, the type of education that is going to be available to them, and just those three things that we're trying to deliver to people: clarity, confidence, and freedom. Clarity to know what's most important in your life, confidence to know the numbers are going to work, and ultimately so that you can experience freedom to go out and live your best life, to spend your time with the people that are most important to you, doing the things that are most important, and not having to worry about money. So that was one thing that I wanted to make sure you were aware of in the calculator. The next thing I wanted to bring your attention to is our community portal. So the purpose of the community, when I originally set this up, was to say, hey, let's crowdsource retirement. Let's try to bring smart people together to share ideas. And one of the things that I love about the community portal is it's become a way for people to communicate directly with me as we continue to develop the calculator, to tell me what they like, what they don't like, if there's bugs or if there's things that need to be fixed. This is a place to be able to have those conversations. But I really want you to think, again, expand your mind when it comes to using the community. If you're getting ready to go on vacation and you're going to take a cruise to Italy, and you want to know the best place to visit in Rome, ask those types of questions in the calculator so that we can bring the best ideas from everybody that's on this retirement journey together. It doesn't just have to be, how do I use the calculator? Here's the things that I need help with. Okay, so getting back to the calculator, we'll start out on the timeline tab. Now, a couple things I want to draw your attention to. First of all, you'll notice this panel. You can expand it or shrink it down to get it out of your way if you need more space. But the timeline tab is where you're going to start this process. So you're going to enter information. So we've got Nancy, she's married. Her birthday is March 1st, 1964. She's planning to retire on December 31st, 2025. She lives in Washington. And we're not going to make a life expectancy adjustment for her at this point. But if you wanted to say, hey, let's not use the Social Security mortality tables. Let's assume everybody in Nancy's family lives to 92. You could put that in there if you wanted to. And then, of course, information. We've got her husband, John, who's born in June 1964. Over here, you can see they're both 60 years old. They've got 1 year to retirement. And the estimated years in retirement, 21 and 24 years, 85 and 82 based on Social Security mortality tables. Then we come down to the liquid investments. And this is where you really can get a clear picture of your net worth, your assets and your liabilities. So you're going to enter things like, in this case, they've got a brokerage account, it's $500,000. It's joint ownership, it's low risk. The acquisition date, so we've had some questions come in about the acquisition date. The calculator is always going to assume a January 1st or January 1st, whatever the current year is for the acquisition date. But if you're expecting to receive an inheritance and you don't want to start counting the rate of return on that inheritance until some point in the future, say there's an inheritance you're going to receive in 10 years, you could make the acquisition date 2034 so that the calculator is not counting a rate of return on those funds until that point. So that's one thing. Another thing you'll notice here is the withdrawal order. So this is one place where you can set the withdrawal order. One of the cool things we do in the calculator is we allow you to say how you want to tap into your money. Do you want to tap into your 401k first, or your IRA, or your Roth, or your individual accounts? And so this is one place that you can do that. And then you can also assign a rate of return. Now, I want to caution you, when you're doing rates of return, I know you can look at the stock market. Most people will tell you over the last 100 years, stock market has averaged 10% per year. I really think it's a mistake to aim too high on your assumed rates of return. And I like to tell people, hope for the best, plan for the worst. So when you're entering rates of return, assuming that you're going to have a diversified portfolio across stocks and bonds, and you assume just a 4% growth rate, if you use a 4% rate of return and the numbers all look really good, then that's going to give you a lot more confidence than if you plug in 7% or 8% and then you miss that target. That could be really devastating. So I'd highly encourage you, whenever you're doing planning, hope for the best, plan for the worst. You'll notice something new. This is brand new. We just released this today, but there's now a lock button here. And I'm going to talk to you more about how the lock button works. But essentially, if you want to make sure that this number never changes so that it's always going to be 4%, even as we're applying different scenarios, you can lock it and it will stay constant at 4%. But for now, I'm not going to lock it. When you enter things like a 401k and you select the account type, it's really important that you select the proper account type, because the account type is going to help us know whether or not required minimum distributions need to come out of the account. And it's also going to help us know about taxation. So make sure you're selecting the right account. This is a new field that we added. It's the 2023 year end balance. And the reason that we put that in there is because if you're already over the required minimum distribution age, so if you've already been taking required minimum distributions, we want those calculations to be as accurate as possible. And so by putting in the December 31st year-end balance, the RMD calculations that we're doing are going to be that much more accurate. So that's a place for you to enter that. Of course, something with a 401k only has one owner. You can't have jointly owned retirement accounts because, again, we're calculating RMDs. The risk is moderate. The acquisition date, the withdrawal order, in this case, we're saying we're going to withdraw the 401k first, and then again, a 4% growth rate. Down here in the left-hand corner is how you delete accounts, this little trash can if you ever need to delete something. We've got a savings account set up. We've got the Roth IRA. In this couple's, this hypothetical scenario, we've given them a house. One of the new things that we added to RBC Pro 4.0 is the ability to assign a growth rate to your real estate. So we'll put in $600,000 and say, again, using a conservative rate of return, we'll say that our real estate appreciates at 4% per year. And then they have a liability. So down here you can see they've got $250,000 on a liability, and it's their mortgage. It's going to be paid off in 15 years in 2039. Okay, so that's assets and liabilities. Now, a couple more things on this tab I want to show you. One of the things I personally like to do is go in on the first of every month and do an update on my assets and liabilities. These are called snapshots. It's a snapshot in time. And what it's designed to do, what I found that it does for me, if you use this feature, is sometimes there can be a lot of really bad news about the way the stock market's performing, or whatever the bad news of the day is, what the Federal Reserve is doing. But when you come in and you actually update your numbers every month, and then you stand back and you look at it on a every 30 days, you're like, boy, for all the bad news is out there, these numbers aren't really that horrible, whether it's up or that great, whether it's up or down. And one of the things I would encourage you to think about is that when you're investing in retirement, this should be a boring area of your financial life. You should not, if investing is causing you sleeplessness or worry or anxiety, you're doing something wrong. You should use broad diversification across asset classes, sectors across the entire globe, keep your fees low, rebalance the portfolio. We like to use ETFs here at Parker Financial. But you want a really good investment strategy because you want your money working hard for you, but you don't want to be taking the money down to the casino or speculating at this phase of life if you're about to enter into retirement. So the purpose of the snapshots is to create these different snapshots in time. And I have snapshots for me personally that go all the way back to when we created the retirement budget calculator. So I can see how this is changing, but you can see I created in this fake model. January 1st, 2019, they had 1.3 million of liquid assets, then it was 1.5, then it was 1.6. The value of the real estate changing over time, that's graphed for you. Up here, you may have noticed we've got a lot more charts to just really make the calculator pop, a lot more charts. Some people are very visible. Now, me personally, I like the tables. I'm a spreadsheet nerd, but I know some of you are not that way. You prefer the visuals, and so we wanted to provide you both. So we've got asset and liability history, liquid asset history, a risk allocation, and then how your money's diversified across different taxes. Okay. Oh, another just real basic thing that people have asked about. So you can see if you click on one of these fields, it will expand. It won't give you the details, so it's right there visible to you. But you can also reorder things just by dragging them and dropping them. Somebody asked me about that the other day. They didn't realize that was possible. Okay, now this is actually amazing to think about. If you think about where we're at today with what the calculator can do, when I started this, my desire was to create a tool that really helped people organize their expenses in a very detailed way, because my belief is, and your belief should be this too, because this is just reality. This is just the way the world works. Retirement is all about cash flow. It's all about making sure you've got enough income coming in to match up with your expenses. And if you head into retirement without really knowing what you're spending, what your expenses are, you really could be in for a rude awakening. We want you to have a really good estimate for how much you're spending, and people get overwhelmed by it. And I remember I was having a talk with a couple once, and I asked them the question. I said, hey, when I say the word budget, what does that mean to you? And some people, that in this case, one of them said, budgeting means being prudent. And the other person said, well, budgeting means having to cut back. And I don't think that's a correct way to think about the tool that we've created here. What we're trying to do is give you confidence to know that your money is going to last for the rest of your life. And if we don't know how much money you spend, there's no way to answer that question. So that's how this all got started. I created a spreadsheet to track my own family's expenses, and not just track my expenses, but really outlay where all of our money was going on a monthly basis. And then that evolved over time. And then the spreadsheet got so complicated that it couldn't be a spreadsheet anymore. Then we put it up into the cloud. Today, it's this app that you're all enjoying. And it does so much more than just this simple budgeting tool that we created it to be initially. But of course, you'll enter in things like income. In this case, they have wages, so $10,000 a month. And they have Social Security that's going to start at a future date. So it's, in this case, $3,500 a month for him. And it's going to start in 2031. And down here, we're going to assume the inflation factor of 3% per year. Notice you've got an icon, lock icon here. This is another place where you can lock those inflation assumptions, because we just rolled out a really cool new feature today that I'm going to show you more about. But if you just want to lock inflation, you can do that by hitting the lock button. And you put the start date in. And of course, we automatically calculate the taxation of Social Security. We automatically calculate the death of one spouse. So when one person dies, we stop the lower Social Security, continue the higher Social Security. So that's already all baked in. But one thing you don't want to do, and I feel like I have to tell this to people over and over again, you do not enter portfolio withdrawals as an income source. Do not enter your IRA, your 401k, your RMDs. Nothing like that should go into this income section. The only thing that goes into income is wages, Social Security, pensions, any guaranteed annuity income that you have, And the one exception to this could be rental income. So if you have rental properties or Airbnb or something, and you want to model what that income looks like, because it's usually a pretty stable income source, you could put that in there. Now, we do give you the ability to put things like dividends and interest in. You really got to be careful with that, because if you're going to, like, let's say you have a CD at the bank and it's paying you 5%. If you enter the income, you're going to get the most accurate tax calculations, which is good. But you just don't want to enter both an income and a rate of return on the CD, because you don't want to see your CD growing at 5% and also be accounting for the income on your tax return. It's one or the other. It's the way that you should do that. Now, there are some ideas that we have about how to make that better going forward, but right now, I would just encourage you to, I mean, if you really want to dial in your taxes for the current year, you can enter those different types of income sources, but I just wouldn't try to project it out for a long period of time. Okay, housing. In this case, I just created two very basic expenses. I've got their essential living expenses are $5,000 per month or $60,000 per year. The annual default inflation is 3%. So if I don't enter anything, the calculator is going to assume a 3% default inflation. And then I also have discretionary expenses of $4,166 per month. And that's a joint expense. I marked it discretionary, and it's going to continue for life. You'll notice up here, you can choose between annual surplus and shortfall or monthly. So you can see how big of a deficit you're running every month. Most people will be running deficit. Some of you won't. Some of you have really good guaranteed income in retirement. But okay, so now once we get the budget in, coming back to the budget, I just want to make sure you guys realize, so you've got this table view down here in terms of your 2024 annual budget details. How's your money coming in and going out by category? You've got your annual budget, which you can use the slide bar to look over different years to see how things are going to be changing. You've got the budget for the current month that shows you the income and expenses you've got coming out, income coming in and expenses going out. And then you have your monthly budget by year. So you can, again, if you want to drag through the years to see how these expenses are going to change, you can. Then, of course, we have the tax module. Now, some of you don't realize this, but this little button here means you can expand or collapse the tax module. And the tax module is taking all the information that you're entering in about your income sources, and it's feeding it into the tax module. And then it's also taking any withdrawals that you're taking from your retirement accounts, it's pulling those into the tax module. So all of that's being accounted for in the tax module. So you can see in this case, they've got $120,000 a year of income. They have IRA distributions coming out because their spending's higher than their income. So their total income is $166,000. That puts them in the 22% bracket, assuming they take the standard deduction, because we have them married filing jointly up here. And we can expand all these different fields. So assuming they take the standard deduction. Now, if you itemize your deductions, you can enter itemized deductions here. So let's say your itemized deductions are $40,000. Notice when you enter that, it shows you the year 2024. And if we go forward to the year 2025, you'll notice that we still assume $40,000 of itemized deductions. So if you increase your itemized deductions this year, but let's say next year you plan to go back down to the standard deduction, then you would want to change that back down to 0 so that you're going to receive the standard deduction rather than the itemized deductions for 2025. Going down, taxes. So we show you what the tax liability is. Let me go back to my current year. You can scroll through your different years. Amount you owe in taxes, $17,000, your effective tax rate. Now, if you have state income taxes and you're showing the dollar amount, that will be right here in this area. And then your total taxes down here. If we collapse this, you'll notice we have lifetime taxes. So you can see how much you're going to pay on lifetime taxes, both by chart and table. We have taxable income by bracket, and then we have your tax tables. So all of this data lives within the tax module. Now, the retirement optimizer is what we used to call the future view, but it's so much more powerful that we wanted to give it a brand new name. So we've got the retirement optimizer. And of course, we have your liquid asset projection, your net worth projection. Notice how you see your real estate growing over time, a budget projection, a bucket strategy if you want to diversify your money across time segments, and then a withdrawal projection. But down below this chart is the base scenario. Now the base scenario is the basic. It's taking all the information you put in and it's saying, okay, here's where we start from, because then you'll see in a minute we have all of these different scenarios that we can overlay on top of your base scenario. So in this view, you'll notice that these folks are both going to be 60 this year. They have $120,000 of income. If we click on the income, we can see what that consists of. So it's wages, the estimated federal income taxes, their net income after taxes, and then all of their expenses are $145,000, but their net income is only $102,000. That means they have a shortfall. They have a deficit. They don't have enough income coming in to cover their expenses. Whenever there's a shortfall, we have to take a portfolio withdrawal. And so in this case, we're taking $43,000 out of this 401k as what we had designated was going to be our withdrawal order. So 40,000 comes out. One of the updates we made to make the calculator more accurate is in the first year of retirement, we are now prorating the rate of return. Even though we said that they get a 4% rate of return, this value updates every day to show what's the rate of return so that this ending balance. What we were running into is people were creating a plan in November, putting a 4% growth rate in, and then ending up with a higher first year value. So now we've prorated it to make it a little bit better. And then of course we show the withdrawal change percentage. Over here, you can click on some additional options. If you want to see the balance change percentage or the year over year change percentage, you can enter that information. But most people, as they're heading into retirement, want to know what their withdrawal rate is. And so that's how you access that information. Now, in this case, you'll notice we have them starting their Social Security at age 67. So they're going to retire at 61. They're not going to have any income for a number of years here. They're still going to have a tax liability because we're going to be pulling money out of their retirement accounts, their 401k. And so you can see these are all of their expenses. This is money that needs to come out of those accounts. So in the RBC, in the retirement budget calculator, we assume withdrawal first and then a rate of return on the remaining balance. Again, hope for the best, plan for the worst from a cash flow perspective. We get down here to Social Security, and we've got both of their Social Security starting at 67. And we run these numbers down, and you can see based on the model that we have, they start with $1.6 million. We get them down to age 79 for both of them, and they've depleted their liquid investable assets down to zero. Now, that doesn't mean their net worth is zero, because in that year, they still have real estate. So they still have the value of their real estate that they could access, 1.3 million. Maybe they do a reverse mortgage at that point, or they sell the house and they downsize, or they move in with the kids. There's all kinds of other options available. But liquid investable assets, the money you can draw from, gets drawn down at this point. And in this case, we're assuming that they live to life expectancy, which is age 85. The yellow line is the year they run out of money. The blue line is his life expectancy, and the pink line is her life expectancy. So now that we've got this baseline model built, now we want to start saying, okay, how do we optimize our financial plan? How do we make it even better? And that's where these different scenarios come in. So a conversion strategy says if you want to see if it makes sense for you to do Roth conversions, you could, create multiple Roth conversions on an annual basis. One way you could do that is come over to the tax tab. You identify years maybe when you're going to be in a lower tax environment. In this case, it shows your taxes are always going up. But maybe you want to look for years when you're going to have a low tax environment. And then you would do conversions during those years. This is a brand new feature that we just added into the calculator today, and it's the expense strategy. Right now, you'll notice all of their expenses are being accounted for. But remember, when we built their budget, we had both essential and discretionary expenses. So now what you can do is you can come over here and say, only show me my essential expenses, turn that on, and say, okay, if we're only spending the money that we absolutely have to spend to be able to live a good life, then you can see we get them all the way down to age 85, and they still have $2 million remaining. So if we turn this off, it's going to assume all expenses. But if we turn it on, then it's just going to show their essential expenses. It's a really cool way, because if the reality is, if all of a sudden things start getting tight, maybe you don't travel as much, or maybe you don't go out to dinner as much. There's things that you can do to cut back on some of those discretionary expenses. And that's why it's so important that you be very detailed when you're entering your expenses into the calculator. Now, another thing that we could do is we could say, geez, if we're getting 4% per year, we run out of money at age 79. maybe we want to change our growth strategy and say, what would happen if we got 5% per year? Oh, 5% gets us all the way down to age 82. Or we could come back in here and say, what if we get 6% per year? 6% gets us all the way to age 85. Okay, so the good news about this is now we know not how much we want to earn, but how much we need to earn in order to make the numbers work. We have a target that we're shooting for. That can be very powerful. Of course, within this, you've got the simple growth rate. Maybe you want to see if you had a 60% stock, 40% bond historical rate of return. And over here, we explain what we're doing and where we're getting these information from. It's basically the S&P 500 and 10-year treasuries going back from 1978, projecting it forward. If we had that type of sequence of return, what kind of situation would we be in? And of course, the numbers look really good. If we had a bad timing sequence of returns where you retire in the year 2000, so you experience the financial crisis and the dot-com bubble, and then we project that from right at the beginning of retirement, how would that look? And of course, with a bad timing sequence of returns, you run out of money at age 78. So we give you the ability to test this a couple of different ways. Again, I think a really good starting place for most people is just assume a 4% growth rate to start with and see how your numbers look that way. This inflation strategy is also something brand new that we just added. Now we give you a lot more control over how you want to assume inflation. So you can have inflation, you can adjust how much you think your income is going to go up. So if you want to adjust your Social Security to a higher than whatever you entered before, you can. Your deduction inflation, you can increase. Expense inflation, you can increase. And now brand new, and this one's really important because we never had this before, is tax inflation. So I wouldn't go higher than 2% on this. That's the highest I would use on tax inflation, but for modeling. So what happens currently in the RBC is under the taxes, if we come up here to the tax tables, we assume by default that taxes, that the tax brackets don't change. So when we apply that 2% inflation factor, what we're assuming is that these values are going to change by 2% and your standard deduction is going to increase by 2%. So you can see the default is these are not changing. So we can look each year and see that there's no change to this. But if we come over and we turn on the inflation strategy, now you'll see that these numbers are all adjusted by a 2% inflation factor. So it's gonna make our tax calculations more accurate, and I think it would be reasonable to assume a little bit of inflation on those. That's historically what's happened, but I would keep it really conservative. I wouldn't go more than 2% on those projections if you're gonna use that feature. Now, again, like I said, this is brand new. So you can lock these expenses. So if you want to have all of your expenses at 3%, you can hit this lock button. But anything that you previously locked is a budget item. So maybe you had a term life policy and that term life policy is not going to go up with inflation. You want to make sure it's locked at 0%. You would hit the lock button next to that expense so that you would not see that expense increasing with inflation. Of course, we don't let you inflate your loans or liabilities, but this is where you could lock an expense. But you can globally go in and change your inflation strategy to see how inflation is going to impact your financial well-being. Another really powerful feature is, remember, in this model, we have them starting Social Security at 67, and we know that their money lasts until 79. But what if we come in here and we say, what if we postpone Social Security to 70 for both people? And I don't know if you saw this or not, but there's this little arrow that you can select the year that you start Social Security, your year of birth, or your birthday, your age. Instead of having to type in the exact number, you can just select when you want it to start based on age. So in this case, we said, what if we started at 70? And then we run these numbers down. Now you'll notice, before we had them running out of money at 79, now we got them an extra year. Now we got them all the way out to age 80. The timeline strategy says, what if we want to say we're using default life expectancy? What if we want to say John's going to die at 75? And then we turn that on. So you'll notice when he dies, only one Social Security continues. The higher of the two continues, which is how Social Security works. And so now we can stress test for his wife, Nancy, to see if she's going to be okay. Or maybe you want to assume you both live to age 100. And then, of course, our withdrawal strategy feature, we've got the conventional withdrawal strategy, we've got proportional withdrawal strategy, or a custom withdrawal strategy. And you can drag and drop to customize this withdrawal strategy for your specific situation. So you can play around with the withdrawal strategy and figure out what's going to work best for you. So I've gone through a lot. I want to make sure I'm answering questions. And I also have a couple of, we're thinking about, so today we just released this new expense strategy. This is brand new, just came out today. And we also released this new inflation strategy, just came out today. We have 30-day sprints. Every month we are working to make this tool better for you. I want to open up my questions and answers and see what you guys have, see what's on your mind here. Oh, question was about goals. So you may have noticed that we removed the goals feature from the new Retirement Budget Calculator Pro version 4.0. We used to allow you to track goals on a daily, monthly, weekly, annual basis and put a little check mark every time you did something. It's something I personally like to use, but we didn't have very many people using it, so we have not built that feature into the new calculator. It doesn't currently exist. Can I do a completely different scenario? Sure. You've got your models up here, so this is how you create different models. You can create up to 4 models. So for example, I created the simple model, but I also created one that's more with more detailed budgeting information, just so you can see what that looked like. You can create multiple models, but you can also create multiple scenarios. So you can come down here, and there's no limit on the number of scenarios you can create. So there's a limit of 4 models, but you can create as many scenarios as you want. Should income be gross or net? Gross. You always enter the gross income because the calculator is doing the tax estimates. And so the calculator is determining what the net income is. Always enter your gross income. How does RBC handle an asset that could normally be sold at some point, like a house? Does the user need to account for this manually by enter the sale? Yes, that's exactly right. You can go in and create a cash flow event. So if you want to come over and into your income, into the income section of the calculator, and you want to say, I'm going to sell a house at a future point, you can do that there. The other thing that we built, though, into the calculator is this new asset conversion. And this is probably the best place for this. So you can come in here and say other conversion, go to asset conversion, do other conversion, house sale. Our source asset is going to be our primary residence. The destination asset, we're going to say we're going to take that money and put it into our brokerage account when we sell it. $600,000 is the amount that we're going to sell it for. Now, it's easy in the current year because you know what the value is, but you don't necessarily know what the value is in a future year. So if you're going to choose a future year, you want to say 100% of the future value and then choose your future year. So we'll say 2034, 10 years out. The income type is going to be long-term capital gains, so it hits your tax return the right way. And then you get to exclude the basis, so how much you paid for the house, improvements that you've made. So let's just say that you're going to oh, you also get your lifetime exemption. So let's just say that it's $500,000 if you're a married couple. That's not going to be taxed on that sale. And we save it. And so then if we go to the retirement optimizer and we look down here in the year 2034, you'll notice that we have created this inflow. So notice now we have this conversion, $923,000. That's being added to the balance of your brokerage account minus the shortfall that you had for the year. So that's probably the best way to be able to do it, and then that way we're accounting for the taxes appropriately as well. Okay. Now you can also do it manually and enter those transactions manually if you'd like to. But what's the recommended way to account for a likely future purchase of a car, for example, say 5-10 years down the road? So what you'd want to do is you'd want to go into your budget and you would want to create an expense for a new car in, say, 10 years. If it's a $50,000 car, create an expense that happens only in 1 year, and then the calculator will know in 10 years from now that you're going to need an additional $60,000. Okay, what's the, let's see, nice, the tax module looks like a 1040 tax form. Yeah, we try to keep it easy to read. Are wages supposed to be gross income? Yes. Okay. Does this compute both the current tax liability as well as things as periodic withdrawals? For example, every 5 years, someone cashes stock. It's going to take into consideration the withdrawals that you're taking, yes, but it's not necessarily going to take into consideration. So if you're pulling out of a brokerage account, it doesn't know if you have dividends and interest and long-term capital gains when you sell that. So you'd have to enter that manually the year that it happens. If you're taking out of your retirement accounts, IRAs, 401ks, then it is going to appropriately account for the distributions that are coming out to cover your shortfall. How do we choose the program which account we want the deficit withdrawal to come from? Okay, cool. So we've got a couple of different ways you can do that. In the assets and liabilities, right now, the way that you would do it is you would set the withdrawal order. So you come up here, you choose your 401k, and you see you've got your withdrawal order here. That's how you could say which account you want funds to come from. Another way that you can do it is you can come down to the withdrawal strategy calculator. And we've got a couple of different ways for you to do this. You've got your conventional withdrawals, which is going to tap into your brokerage and savings account first, then tax deferred second, and then Roth IRA third. You've got proportional, which is going to be coming from taxable and tax deferred accounts in equal percentages, and then tax-free last. Or we have the custom, which allows you to create any kind of withdrawal strategy you want. So those are the ways that you would create those different withdrawals. One of the things that you have the ability to do is if you need help from an advisor. Now, we don't work for free as advisors, so there are fees associated with hiring advisors. But if you click this Discover Your Wealth Manager, and this is something that you don't want to do on your own, maybe this is just overwhelming to you, you can book a free discovery session here, and then you can meet with somebody on our team to help you navigate your retirement planning. We can help with investment management. So you don't have to go this alone. We're there if you need us. Okay, the next question is, no, you do not enter 401ks as income. All you do is you enter your income and your expenses, and the calculator will determine how much money needs to come out of your 401k to supplement the difference between those two numbers. Do not enter portfolio withdrawals as income. So down here, you'll notice they have a shortfall. They have income, let's go down to retirement. So they've got $54,000 of income, $24,000 of tax. Their net income is $30,000. Their budget requires $171,000. They need to take a portfolio withdrawal for $140,000. And we have it coming out of the 401k. So in the year 2031, you see they've got the IRA distribution, then they've got their Social Security, and we calculate how much of their Social Security is taxable. And you've got total income of $186,000 and a standard deduction of $32,000 at that point because they're over age 65. So that's how you do it. You don't enter portfolio withdrawals as an income source. Okay, do we have access to this example scenario? No, this is just something I built real quick before the webinar. Do you have a doc with all these features, options? No, we don't have a document with all these features and options, but you do have Finn, your friendly, and you can ask him any question you have about the calculator, and he's going to give you a pretty darn good answer. And Finn's getting better and smarter all the time when it comes to how to use the retirement budget calculator. He's really good if you ask him just general financial planning questions, estate planning questions, insurance questions, and he's getting better and better all the time at answering questions about the calculator. Do you cover Social Security optimization? Can you cover Social Security optimization? Well, there's a lot of tools. So if you come up to the community portal, we've got tools in here to be able to help you figure out how to optimize Social Security. So if you click on this link, it will take you to open Social Security, calculate your Social Security benefits. We've got different tools in here to help you understand how to optimize Social Security. And then when you use that information, what you want to do is you want to come over to the calculator and plug in those different variables for your situation. So you create your initial income, Social Security, but then down here, you can say, okay, the baseline was I wanted to start it at 67. What if we were to start it at 70 instead? Or what if we started at 62 instead? And then you can look at the values, the numbers to see how it impacts your plan. I have a if you have like your wife, let's say your wife starts her Social Security now and you're postponing yours. And then when you turn on yours, she's going to get the higher 50% benefit. So when you create your income for your spouse, you would just have a stop date on when one Social Security is going to end. So you would have an end date there to show that it's going to end at some point in the future. And then you would create a new Social Security income for her when the spousal benefit kicks in. So you have one income stop and you have another one start. I have a pre-tax account that is only accessible when I take a pension at 65. Any way to model that? Yeah, you could just play around with the withdrawal order and make sure you have it in the right spot so that it's accessible at 65. Now, is it a pre-tax account that's going to be paid out in sometimes people have pre-tax accounts that get paid out in a specific order. So like when you set it up, you had to agree to have a payout over a 10-year period of time. If that's the case, then I would enter it as income and not as an asset if you have a specific withdrawal order you have to follow. Okay. This guy says, that's incredible that a majority do not want to be able to link accounts. Oh, I know. A lot of this is incredible to me, actually. I ask these questions, I think, oh, everybody's going to want this, but not everybody does. It surprises me. How do you copy different scenarios? Is that still an option? Yes. Now you've got scenarios or models. A lot of times what people are wanting to know is how to, up here, let me delete this one. Okay, now one thing to remember is you can't delete the current model. So notice this is the model I'm in. There's no delete button here because I'm in the current model. You have to delete a model that's not currently selected. But let's say I want to create a new model and I want to use the base model as my webinar simple. And so that's how you just duplicate all the entries that I currently have. And now I've created a new model. It's just called new model, and I can switch back to my webinar simple. Yep, you can schedule a big purchase in the future. Just enter it as a one-time expense that happens only in that 1 year. I'm not quite understanding how to add state taxes. Yes, state taxes, right now you cannot enter it as a percentage. That was one of the things I was asking you if you'd like to see that put in. But you would have to enter your taxes here, and you come over, hit this green button, and then you can hit state income taxes. Right now, the only way to model state income taxes is a dollar amount. If you want to model your state income taxes, you have to put in what you think the dollar amount is you're going to pay in state income taxes, and then we'll net out the income based on that. Can you copy models? Yes. One of the items is life expectancy. That really places a different view on how to look at these numbers. Yes, life expectancy does. If you're going to live a long time, you want to, again, hope for the best, plan for the worst. When we do planning, we always assume age 100, or we'll leave it at life expectancy as the baseline, but then in the timeline strategy, we'll turn it to age 100, and then we'll show people what the difference is if you live to life expectancy versus age 100. How do you track or input major unexpected expenses? We've talked about that. You just create a 1-year expense in the year it's going to happen, and make sure it only happens that 1 year. So you don't want it to be an expense that happens every year. It just happens one time. It's an annual expense that happens one time. There's no opportunity to print out of the RBC at this point. I want to use a bucket strategy, short-term cash, mid-range balance, long-term mostly equity. How does that withdrawal strategy work from my different buckets? You could just match up your withdrawal strategy with the way that you've got your buckets situated so that you're drawing out of those accounts appropriately. How would you enter an inheritance at a future point? Again, just create an income stream, a one-time income stream. If it's going to be taxable or tax-free, most times it's tax-free unless it's a retirement account. Can I include a guaranteed inheritance in my plan? Yep, you can. So again, just create that one-time event to show that asset acquisition date at a future point. My husband received disability, veteran income, it's tax-free. How would I put that into the calculator? That's a good question. So here under income, you could do, what's our best option? You could do pensions and annuities non-taxable. That would probably be the best way to enter it. Let's see, I'm currently taking a monthly withdrawal from an IRA account. How would I enter that? Again, you do not enter withdrawals as an income source. You increase your expenses so that it forces a withdrawal on the retirement optimizer. If you want to show a withdrawal coming out of your portfolio, increase your expenses until you have that withdrawal coming out. But let's see, how does the calculator have a percentage success for each scenario model? It's not a percentage success. It just shows you on the chart. You can just see the numbers visually if it's gonna succeed or it's not based on the assumptions you make. And the cool thing is, in the scenario, you can turn on multiple scenarios at one time, multiple eyes at one time to say, okay, if I use this growth strategy, this inflation strategy, this social security strategy, this timeline strategy, and this withdrawal strategy, how do all those pieces come together to support my financial plan? What's the best way to account for an unmarried couple who then get married? I would just create a new model. So have individual couples now, and then when you're married, create a new model with both of you in there. Other than order of withdrawal, can you specify the amount or percent of withdrawal each year? No. The withdrawal that you're going to take is going to be based on your expenses. If you want to increase your expenses, that's how you increase your withdrawals. What does reserved mean? Reserved on the withdrawal strategy means, for example, if you have an emergency fund and that money is not intended to be used for supplementing your cash flow, you would drag that account down into the reserved account, and it will be spent if all of the other money is gone, but the intent is that's money that's not going to be touched to help supplement cash flow. Does the calculator have an optimizer to compute what percentage of an IRA to convert to Roth, or is it up to us to decide that percentage? Again, yeah, the way that you would determine that, the best way to do it in the calculator is to look at the taxes tab, probably identify years when your taxes are going to be lower, and then you can play around with the numbers to see how much you could convert. But no, the calculator doesn't make recommendations to you, it just tells you how you can find that information. How do you enter updated accounts in the 401k without creating a snapshot? How do you enter updated amounts in the 401k without creating a snapshot? You can do it a couple of different ways. You can use the snapshot tool to update the 401k balance, or you can just go right into the asset itself and edit it and update the balance. What does commit scenario override in your plan? The commit scenario, you'll notice we've removed the commit scenario button from the main navigator section. That was creating confusion for people. But basically, when you commit a scenario, it just says, this is what I want to have happen. And it's going to take all of those and make them permanent within the plan. Let's say that you had said 67, you created a model or a scenario that says, I'm going to start Social Security at 70. You can commit that scenario, and then it will change your baseline assumption to assume that Social Security starts at 70 instead of 67. So it just takes those what ifs and makes them the permanent plan going forward. Can you limit the amount of withdrawal per account, or will it take the full amount until required? Yeah, so that's where you could use like the proportional strategy or a custom strategy to determine your withdrawal rates. Is Fin available in the free version? No, Fin is a paid version, a paid tool. When you change the date of your Social Security withdrawal, does the calculator automatically adjust the amount? No, you have to enter a dollar amount that you expect Social Security to be. You can find your Social Security on your Social Security statement. What's it going to be at 62, 67, 70, and you would enter in those amounts. How do you create a new budget for each year? You have one of the things, again, the way that we created the calculator was so you can be as detailed as you want. You can create very detailed budgets, and you can start and stop expenses. If you have an expense that's going to happen only this year, you could create a whole set of budget items that only happen in 2024, and then create a whole new set of budget items that only happen in 2025. I don't think that's the most efficient way to think about using the calculator, but you could certainly do that. What measures do you try to optimize? All of them. Do you add an estimated tax payment as an expense? You can. So up here in your budget, you notice we have tax withholdings. So if you're withholding taxes, you can put in federal tax withholdings. Now, the calculator is always going to default to using the calculations we're doing for federal taxes. But what it does is over on the tax tab, if you'll notice, it'll show you what the tax is based on what we've calculated, but then it will also down here on line 25 show you the amount that you withheld, so that you'll see if you're going to owe taxes or get a refund based on the difference there. Is the only way to track net worth by snapshot? Can you add previous years? Yes, you can add previous years, and yes, that's the only way to track your net worth is through snapshots. And if we make a change to the base model, will it carry over into other models? Only if you copy that into a new model. So it won't automatically change other models. You would actually have to create a new model and copy that into the new model if you want to take that forward. And you guys, that was the last of the questions. I think we got it all. I thank you all for being Retirement Budget Calculator customers, for being here on a Friday afternoon, for answering and helping us design the calculator to make it better going forward. And that you'd be here on a Friday afternoon when it's sunny and warm in the middle of summer. So thank you for that. And without any, if there's no additional questions, I'll let you get to your weekend. Thanks so much, everybody.